So the Bank of Japan, they've opted to keep rates on hold at negative 0.1%, as well as keeping its 10-year government bond yield at around 0%, which no surprise there, right? However, market reaction so far has been pretty much range-bound. And if we look at it in this case, we're looking at a weekly chart, but we can see that although the technicals are bullish on a long-term level, and you can see that there's a bit of a bull trend line, however, overall it's been stuck at a short-term resistance level, unable to really breach the 110 level, so stuck around 109.70s. And what's that done from a trader standpoint is we can see that retail sentiment has started to, retail traders have started to trade that range-bound territory, and that's why the sentiment has started to shift back and forth. Blue dotted line for retail sentiment, green dotted line for COT sentiment, or larger speculative traders, according to the Commitment of Traders report out of the CFTC. Now, in the case of the COT, they're holding a majority long USD JPY or majority short yen bias, but it wasn't always like that. In fact, when the USD JPY was dropping, they actually shifted their bias to majority short USD JPY. In other words, they became majority long yen. And the reason why they did that was because they were anticipating further risk-off scenarios, those scenarios where investors would snap up safe haven assets like the yen and dump riskier assets like equities. The opposite has happened, and since then they've adapted and shifted back towards a majority long bias, anticipating further gains. Retail traders, on the other hand, they may continue to trade these ranges. However, if we do get a move higher in line with its current technical bullish overview in the long term, then that is obviously going to put a squeeze on those shorts. So that's it for the yen and the Bank of Japan. The pound and the Bank of England, they're up next. Until then, happy sales.